Hi all, welcome to my YouTube channel Banking Regulation Simplified. In this channel, you will understand the latest trends of banking regulation, understand in-depth concepts of banking regulation, and also you can use this YouTube channel to catapult your career in the world of banking regulations. Good luck. Hi all, welcome to our YouTube channel Banking Regulation Simplified. In today's video, we shall see about an important concept in the world of banking regulations that's known as Basel-IV. Basel-IV, the latest version of the Basel Accords, and is in implementation in some of the major economies, and will also be shortly rolled out or implemented in other major economies like US, European Union, and UK. So, if you're serious about a career in the world of banking regulations or want to catapult your career on the world of banking regulations, then you need to know Basel IV, because that will be in abeyance or in implementation and will be followed throughout the banking fraternity across the world for the next 15-20 years. So on that count, this video assumes significance, a lot of significance. In the earlier video, I would have posted a high level overview of the concepts. Today's video will be slightly detailed. We'll take a look at what really are the changes under Basel IV, which are the important areas it changes, what are the tweaks it does, and what is the game changer in it, and how it tries to address the anomalies or the shortcomings of Basel III. So we shall take a look at all these concepts and aspects in a detailed level, at a detailed level. Now let's get into this video. Just in case if the video is not clear, I shall attach a copy of the slides towards the end of the video. Now let's get into the video. Okay, Basel is the most comprehensive. Of course, anything which is latest will be the most comprehensive and the better version of compared to the previous versions. And so Basel III, just a historical background to it. Basel III was developed through baptism of fire, meaning the BCBS committee observed the developments and how things took a bad turn around the 2007-8 crisis, and also closely understood what was the weak links or the gaps in the banking regulation framework, that's the Basel II framework, and accordingly came with Basel III. Okay, so Basel III was groundbreaking and incremental and had no precedents way back in 2010, and it came up with a slew of capital ratio buffers, leverage ratio, and liquidity ratios, and kind of increase the safety cushion for banks in all types of scenarios, good or bad. So these safety cushions, the capital buffers and the liquidity ratios came good during times like the recent COVID-19 crisis. So that's a proof or trust to the success of Basel III. But still, the world of banking regulations was highly uneven, wherein banks operating in the same economy, same geography, catering to the same profile of customers, were quoting a different number of RWAs and capital ratios. This is actually unacceptable, right? And the risk parameters would be the same for the same economy and same customer profiles. How this anomaly or unevenness did even exist? This was because due to the internal models adopted by banks through which they were able to quote their RWA estimates or calculations through the adoption of their own RWA parameters, which is allowed under the internal models. But from a regulatory lens, this is not acceptable for a simple reason. If the risks surrounding the same environment or the same economy would be same and will be equally applicable to all the participating banks, and if any of them would fail, and unfortunately they had quoted their RWA and capital estimates on the lower side, they will be ill prepared to face such contingencies and probably will get washed away, which will have a cascading effect across the global banking domain. So all these things are the need of the hour, and they need to be addressed to bring about an uniformity and also reduce the scope for arbitrage or probably eliminate arbitrage. So this is what is the crux of Basel IV. This is what is the ideology behind Basel IV Accords. So they have come after a gap of 7 years. 2010 was when Basel III was implemented, was published, and December 2017 was when Basel IV Accords were published. Okay, so Like I said earlier, they measure risk standardizing, tightening model permissions, and introducing more risk sensitive parameters across credit, market, and operational risk, the three key components behind the pillar one components. And it's not merely recalibration, like some small tweaks here and there to increase the amount of cushion or improve the levels of safety. It's not about that. It's a complete radical revamp, meaning some of the existing methods have got abolished under these major components of pillar 1, and there will be new methods which need to be adopted, meaning banks need to stop what they've been doing to calculate and report these risk numbers, and rather adopt new numbers, which would mean a complete revamp in their own systems, processes, and organization structures. Okay, these are the important changes. Credit risk framework overhaul, operational risk overhaul, credit valuation adjustment, which is a subset under credit risk, market risk overhaul, output floor, which will be applicable to credit risk, leverage ratio, GC buffers, which will be applicable under credit risk, and output integration and disclosure. If I were to give a snapshot of the important changes under Basel-IV, these 7 would be the takeaway, and we shall see these 7 points in detail now. Okay, major components under Basel-IV, credit risk. So it has revised a standardized method, which is supervisory driven, and also made some amendments, key amendments to the IRB approach, which is partially supervisory driven and or sometimes fully driven by the bank. So stricter risk weights, limits on internal model, more granularity by exposure type. Operational risk, there were earlier 3 methods, BIA, TSA, AMA, all of them have been abolished, and there is a new method which is known as single standardized measurement approach, meaning operational risk is a serious process, it's not just a tick in the box. Similarly, credit valuation adjustment, so it has introduced a new standardized and a basic approach, and it has aligned the CVA calculation methodologies with the trade booking standards, meaning under the FRTB, which we shall see, FRTB method amendments, there is a clear delineation between the consideration or the or the treatment under both the banking book and the trading book. CVA further strengthens that aspect by clearly telling what are the aspects which need to be coming under CVA capital charge and what need to be quoted under market risk. So which would mean there is a further refinement to the calculation and the treatment methodologies under the CVA. And earlier there was an internal CVA method which was used by a select few banks, that has been totally abolished because of the, for many reasons. One of the main reasons is because of the slow acceptance or the low amount of usage amongst the banking fraternity. Output floor. So this decreases the gap between the RWA estimates between the internal method and the standardized method, and ensures the output of the internal method for RWA is at least a bare minimum of 72.5% of the output of the standardized RWA calculation. So this is a game changer. So leverage ratio, which was a game changer under Basel III, has been slightly strengthened by keeping additional ratios for GSIBs, meaning globally systematically important banks, meaning Basel IV still has a concern for strong banks and wants to ensure they are safe at all times, considering the kind of economic uncertainty we are in. So what they have done is, apart from stating separate buffers for GSIB, they have also increased the amount of leverage ratio for GSIBs. And market risk. So fundamental review of the trading book. This is a key concept. So the takeaways, there was earlier a method known as VAR, value at risk, for calculation of market risk, that has been totally abolished, and there's a new method known as expected shortfall or ES. So apart from that, they have clearly defined the standards for calculation under the banking book and the trading book, which we shall see now. Okay, now the credit risk framework work overhaul. The standardized approach is now very granular and risk sensitive. Now we shall see the credit risk framework overhaul. So the revisions to the standardized approach. The standardized approach is now far more granular and risk sensitive, meaning what are the key areas they have touched? The RWA parameters for high loan to value real estate lending and low rated corporates have got increased. meaning you need to clearly define the kind of corporates you're lending, whether they're rated or not rated. If they're not rated, the RW treatment for them is higher. Similarly, if you are into the business of residential mortgage lending, the loan to value ratio plays a critical component. The lower the loan to value ratio means the lesser the RWA, higher the loan to value ratio means higher the RWA, meaning loan to value, in other words, is the loan amount compared to the value of the property. In other words, this is a crucial metric for calculation during default, meaning if the client were to default on their obligations of paying back the dues, the mortgage property will be used for auction to regain the dues. In those scenarios, the LTV value is very critical. Let's take an example of LTV value of 50%, meaning in those scenarios, if the client were default, you can very well auction the property, get back your dues, and probably have some excess amount which you can pay back to the client who has already defaulted, which will be probably helpful to the client. On the other hand, if the loan to value ratio, LTV ratio, are to be high, when you auction it, you make it the bare minimum to take care of your dues, or probably a little shorter than that, and will probably not have enough money to give back to the client who has defaulted. Okay, so this is where the concept of LTV ratio is coming. So to handle the defaults and also take care of default proceeds, when the LTV ratio increases, the RWA also gets increased, meaning you have already set aside a higher RWA and higher and and a relative higher capital. So any contingencies like a default can be handled better, even if it were to go through the auction mode. That's the idea behind the higher RWA for a higher LTV. And low rated corporates. So if a corporate were not rated by an external agency, meaning they are not in the radar, or probably they are yet to break into the league. But if you were to lend to them, so it could be a double whammy. It could be rewarding at the same time could be risky as well. So to take care of them, take care of the risk aspect, we need to increase the RW part. At the same time, if the loan are to be well collateralized or a low risk loan or a highly rated corporate, the RW component will be less. So revised internal rating based approach, IRB, is one of the most sophisticated models in the world of banking regulation and involves a lot of formulas and calculation. We shall see them in detail in one of the subsequent videos, but how they are getting impacted under Basel-IV is the foundation IRB and advanced IRB. The foundation IRB has one lever given by the regulator. Basically, the IRB method has four levers: PD, probability of default; LGD, loss given default; EAD, exposure at default; and 4 is known as maturity. Okay, under the FIRB, foundation IRB, the client can model the LGD, EAD in maturity, whereas a PD will be given by the supervisor. On the other hand, the ARB, all the four parameters can be modeled by the bank itself. So this is where the anomaly comes in reporting of the RWA numbers for the same set of clients, same set of banks operating in the same region, because banks with a better control or understanding of this IRB methodology will be able to quote their RWA numbers and thereby quote the capital numbers, which from a regulatory lens is not acceptable. It has to be a level playing field and a uniform uniform blanket or uniform reporting standards or levels for all banks applicable. So from those lens or from those perspective, the overall of the IRB methods has happened. With respect to exposures to corporates, so it clearly you need to differentiate between the corporates whether they are rated or not rated. Similarly, the risk weight is based on the revenue and leverage for specialist lending. For unrated corporates, the risk weight is based on the revenue and leverage. Similarly, for specialist lending like object finance and project finance, they get a slotting methodology. So in short, it differentiates between strong and weak corporates even if unrated. Banks. So there is a methodology, but now the methodology has got still simplified. It is based on the CET1 ratio and Tier 1 leverage ratio, and the RW is dependent on the counterparty strength, meaning if your peer bank or the bank to which you're lending has a higher levels of capital and is conservative on the capital front or strong on the capital front, meaning obviously the risk of a default or the handling of default would be done better by them, and they will be relatively safe in a crisis. So that needs to be rewarded in the form of a better RWA when you lend to them. So all these aspects will be taken care when under the IRB methodology for banks. Similarly, so in other words, it reduces the over reliance on external ratings and has given some aspects or some added some flavors in how you calculate the IRB methodology for bank lending. Retail segment is one of the most volatile and rewarding segments for all banks. So retail segment was one of the most devastated and highly impacted in the aftermath of the COVID-19 crisis. So how that has been handled or how that has got addressed under the Basel-IV. Please remember the Basel-IV Accords came much before the COVID-19 crisis, around in December 2017, and would have got implemented by now. But due to the COVID-19 crisis and the kind of impact it had on the bank's balance sheets, the implementation timelines for Basel-IV have got slightly moved. But even from a post COVID-19 perspective, where the retail segment had got highly impacted, was subject to a lot of defaults and subject to a lot of high levels of lending, high rates of lending. I think from these aspects, Basel IV are already addressed, and how we shall see now. So they clearly distinguish between regulatory retail. Regulatory retail is, in other words, the kind of customers who take personal loans or use credit cards or ODs for their personal use. It was clearly told, categorize them into two buckets: transactors and revolvers. Transactors are people who let's take the example of a credit card. Transactors are the people who use a credit card and pay it back before the next due date or on the due date. Meaning they use the credit cards and pay them back and have nil outstanding balance in the next cycle. On the other hand, a revolver is a person who will use a credit card uh, and the next due date will partially pay some amount and leave it as an outstanding in the next cycle, and slowly will pay off them. While he pays off the old debts, he may maybe subsequently or simultaneously using the credit card for other purchases. In other words, they will always have an outstanding balance, but they'll continue to pay their old expenses, but will at the same time keep incurring new expenses. So from a customer perspective, a transactor is a lot safer and lot better compared to a revolver or a revolving customer. So what Basel IV is telling, a transactor customer who has nil outstanding balance after the due date or on or before the due date needs to be rewarded through the RW calculations or the RW treatment, meaning they'll have a lower RW. And a revolver was slightly kind of vulnerable and wavering in terms of usage, and always has an outstanding balance, and is kind of unpredictable and dependable on their means of lending to sustain for life sustenance, is kind of considered risky from a calculation perspective, hence needs to be given a higher RWA or higher risk weight for calculation of RWA. Okay, so in other words, it has clearly delineated and has clearly categorized the types of customers and how they need to be considered for RW calculation. So residential retail real estate, or in other words, residential mortgage, like we saw earlier, loan to value ratio, lower the LTV, lower RWA, higher the LTV, higher RWA, and to increase the amount of credit risk quality by through according the correct amounts of RWA through linking to the LTV values, and also rewarding whenever it is highly collateralized. In commercial real estate is a special category wherein the client borrows money for building of a commercial property, which could be, let's say, a mall or a building, or let's say some godown, and the proceeds or the financial proceeds income from that property will be used to pay back the loan. Okay, so this is a special type of lending wherein the collateral, the guarantee, the source, everything is valued on a property which will be built by lending, and that lent money will be paid back through the financial proceeds of that property. So this is what commercial real estate is. And in these scenarios, if the income dependency or the financial dependency is has been increased up to 130 percentage RW, and lower the income dependency on the commercial real estate, higher, lower the RWA, and higher the dependence, higher RWA. Okay, so in other words, it is clear, it is similar to the reforms we saw in the retail part or the residential mortgage. The dependence on that particular part for getting back your proceeds in the event of a default, or at the same time in the case of CRE, dependence on that property to pay back the proceeds, means you need to accord a higher level of RW. Off balance sheet review, off balance sheet items. So this was one of the banking products which caused a lot of devastation during the 2007-8 crisis. Meaning, so these will be unutilized balances lying in your credit card, ODs, or in your personal loan or your revolving loans. And in times of a contingency or a crisis, this will be the first choice of lending for customers to handle the scenarios, and will probably be never paid. So in 2007-8, what happened is banks had underestimated this kind of or did not predict this kind of a behavior from their customers, and did not calculate for these kind of products from a regulatory capital point of view. So, and there is something known as credit conversion factor, CCF, wherein it quantifies the amount of RWA for such unutilized amounts and brings them under the ambit of regulatory capital. Okay, so there are many types of products under the CCF bucket happens. So broadly they are classified as committed, uncommitted, the tenure which could be less than 1 year or greater than 1 year, conditionally cancelable, conditionally non-cancelable. It depends on the type of the product. What it has done is, for products which are vulnerable or which are highly probable, which have a high probability of usage during an exigency or a contingency, it has increased the amount of CCF, meaning the amount of RW and capital you quote for these products has increased subsequently. Okay, this is what it has done. It has aligned the capital requirement to the true drawdown risk. A true drawdown risk is a behavior or a scenario which we shall see during a prolonged crisis or an adverse crisis from a customer who wants to use all available means of finance to handle to take care of themselves and their commitments and to survive, and probably are the most vulnerable in terms of a default, because when a customer is already low on finance levels and staring down the barrel, and when these options are available for them for usage, the natural human tendency is for them to use them and probably not pay them back, considering the dire situation they would be in. So these are the overall under the ARB. So ARB has been prohibited for equities and banks and large corporates trade which has a total annual sales of greater than 500 million. Meaning these asset classes can either use the standardized methodology or the FIRB. Input floors, minimum PD of 0.005 and LGD floors 10% for unsecured and 5% secured. So meaning this is another lever which has been tightened, meaning if the parameters are kept low, the output will be low, thereby directly lowering the amount of capital. But when the parameters are kept high or kept at a floor, the amount of the levels to which you can reduce the RW in capital cannot be much or highly constricted. So this is what it achieves by keeping constraints on the input floors. Parameter estimation rules. Okay, there will be always, these internal models will always be subject to regulatory scrutiny. So and these internal models are built based on historical data with the bank and in the macroeconomy, and for a longer period like 10 years, 15 years, 20 years. So what they're doing is, the history requirements or the legacy data requirements have been made very strict. The validation and the downturn LGD calibration, LGD stands for loss given default, are stricter, and have reduced a few favorable scenarios and have introduced a few unfavorable scenarios for a bank. But from a macroeconomic perspective, these are much warranted. We shall see these scenarios in one of the videos later. So in other words, from a model calculation or from a model validation, it has improved the robustness and the conservatism involved in the IRB output. Okay, now we are in operational risk. So like I said, all these approaches are old approaches have been fully abolished. So what it has done is, it has made the operational risk output for all banks comparable or for equivalent banks comparable, and has increased the amount of rigor required for calculation of operational risk. So this is a new method, SMA, which stands for standard. I'm sorry, I'll come back on this. So this is the output of the calculation methodology for SMA. So operational risk is a function of the business indicator and the internal loss. The business indicator is the average of income statement components, interest, fee, rating, trading and other income, and the BA component is a product of the BI into the progressive marginal coefficient, similar to the tax brackets. So this is the marginal coefficient bracket. So if it's less than 1 billion, it's 12 percentage. If it's between 1 to 30 billion, it's 15 percentage. If it's greater than 13 billion, it's 18 percentage. In other words, the larger the size of the bank, the higher the value of this BI component would be, meaning the amount of operational risk also will be higher, considering the massive size of the operations and the size of the bank's balance sheet. And ILM, internal loss multiplier. So it is, if a bank were to have a higher, a bad track record or a bad history of operational risk or operational errors, this component will be higher. If it were to have a smooth record or a clean record with respect to handling of operational risk or operational errors, or little or no incidents or history of operational errors or risk, then this component will be kept at a minimal. So in other words, operational risk is a component of the size and the complexity of a bank into the history of operational risk or errors for the bank. So if the size were to be high and the history is bad, the operational risk RW will be high. If the size were to be high and the operational risk history were to be low, it will be slightly lower. And if the size were to be low and the operational risk error also were to be lower, it will be at the lowest. Meaning it's a product, or it factors in the size of the bank and the history of the operational risk. This is the overall to the credit valuation. Credit valuation is, in other words, quantifying or calculating the amount of market risk in your market positions and how that will suddenly get out of hand and jeopardize your positions and thereby inflict a risk or a default on you. So this was introduced under the Basel-III. Okay, so this is a slightly complicated concept. I will prepare a video on this, but the takeaway under Basel-IV is, it has introduced two methods for under the CVA: standardized CVA, which is model based and risk sensitive. The other one is basic CVA, which is simpler and for smaller banks. But the reason behind basic CVA is the calculation methodology behind CVA are data intensive or data hungry. A lot of systems need to be set up and your organization process needs to be revamped, which will be too much of an ask on smaller banks considering the brunt they will take under Basel-IV. So as a concession, smaller banks can adopt the basic CVA, and slightly mature or bigger banks can adopt the SCA CVA. And earlier there was an internal method under CVA that has been completely abolished. Like I said earlier, this is aligning the sensitivities and hedging recognition in the FRTB framework. Market risk. There are three components of risk: counterparty credit risk (CCR), CVA credit valuation adjustment, and market risk. All these are done at the intersection of the market positions. Whereas CCR and CVA would fall under the ambit of credit risk, market risk is a separate world altogether, a subworld altogether. There are certain common synergies among them, which were not clear or probably were exploited by banks. So this has been made clear, and this exploitation has been abolished by certain clear demarcations under the Basel-IV. This is a slightly detailed aspect reserved for another video. So now what it has done is the CVA capital is under the banking book and more consistent with the trading book risks, and OTC derivatives, basically derivatives which do not fall under the ambit of a counterparty clearinghouse or the standard exchanges, but are done between two counterparties and are highly customized, are the amount of RWA and the capital for them will be higher, because that's a gray area, and the size of the OTC market demands that. The OTC market is many more times of the global GDP itself, and this needs to be handled with kids gloves and can't be completely eliminated for the benefits it accrues for the respective clientele. But at the same time, the OTC derivative played havoc during the 2007-8 crisis. So lessons learned, lessons remembered. So if you do not have the reporting methodologies, the calculation methodologies for OTC derivatives, then you need to pay higher for them. That's the lesson or the takeaway under the CVA revamp. Market risk, fundamental review of the trading book. So the earlier method where value at risk has been replaced with expected shortfall. So it is clearly demarcated trading book versus the banking book boundary, and it has introduced two main approaches. One is a standardized approach for risk factor sensitivities, and an internal model approach for stricter approval. So meaning you need to show a lot of maturity and process maturity and meet the regulatory requirements to adopt this. But this is more of a uniform rollout and easy to adopt, but it will be punitive or probably conservative. So these are the overall under the market risk. So what it has done is the liquidity horizons has been increased and linked to the risk factor, and there are some certain elements in the calculation methodology known as NMRF, non-modelable risk factors. Now they are subject to additional add-on factors, meaning those parameters will increase and the output will subsequently increase. And like I said, IMA, which is stringent, so a lot of back testing, meaning on you need to work on simulations and reverse engineering at the same time, show how this would have impacted your positions in the in the past or the predated information, and also show the delta between the old method and the new method. So it involves a lot of preparation, a lot of data crunching and data reporting. And but what it means is you can't get this IMA approval under the market risk without meeting these two criteria, which is backtesting and profit and loss attribution. Meaning, in other words, the new methodologies, though simple, though better, are data intensive, and banks definitely need to ramp up their infrastructure to take care of these requirements, which of course will be an additional cost or burden on them. So output floor, game changer. Simple words, if the RWA under the standardized method is $100 and under Basel-III if it were to be $50, a bank using approved IRB methodology can still quote as $50 and quote lesser capital. But under Basel-IV, it's no longer allowed. If it output under standard is 100 and output under IRB is at 50, this needs to be increased to 72.5, and equivalent amount of capital need to be set aside. In other words, it's bridging the gap between standardized and IRB. At the same time, there a gap exists to reward the maturity or the process preparedness of a bank which is adopting IRB. At the same time, it's trying to bring things uniform or more or less uniform. So in the future, the incentives for adopting IRB method will slowly fade away, and probably things will move to a more standardized method. This is what the regulator aspires for, but that needs to be seen. And this adoption of 72.5%, okay, this is the formula. Output floor is max model RWA or 72.5% into standardized RWA. But the 72.5% adoption is not straight away. It is more of a phased approach, meaning to start with 50, 55, then finally end at 72.5. It's expected to be adopted by 2030. Some countries earlier, some countries beyond that as well. But by early 2030s, output floor is something which will be uniform. So what it does is it caps the benefit of internal models, boosts comparability. For many GSIPs, it's the single largest driver, because they got away by quoting lower IRB RWAs for the credit component. And when if that were to increase by 50%, you can imagine the amount of capital that needs to be set aside. That meaning the RW estimates which are expected to increase by 15 to 20% under the Basel-IV adoption. One of the main reasons for that is the concept of output floor. Leverage ratio, it's linking the tier 1 capital to the exposures. So this has been slightly tweaked. The exposure measures now includes derivatives under the SACR, standardized counterparty credit risk, of certain off-balance sheet items, and has also given some benefits for margin benefits. So revised Pillar 3 templates. So the additional templates have got introduced, and banks need to report both the standardized and IRB methods to show the impact of output floor on their final RW numbers. And it also lays a lot of impetus on transparency of model use, IRB restrictions, and exposure type granularity. Meaning the granularity which has got introduced for various type of customers, like corporates for rated, not rated, residential markets depending on LTV, or regulatory retail, transactors and revolvers. All that kind of granularity now needs to be reported under Basel III, because they have got advocated and embedded under the Basel IV overall for Pillar 3 disclosures. Okay, this is the QIS, or quantitative impact summary. For credit risk, it is expected under standardized method, it is expected to increase by 10 to 20% because of higher RW for real estates and SMEs. For credit risk under IRB, expected to increase by 5 to 15%, mainly due to the increase in the input floors, like floors for PD and LGD, and output floor, pegging the IRB output to a percentage, 72.5% of the standardized. Operational risk, all the existing methods have got removed. The AMA was used for quoting the operational risk, now that has got abolished, and there is a uniform method, SMA, which links the bank size to the history of operational risk errors. And market risk, the old method was, this is where there will be a substantial increase of 30 to 50%. The old method of VAR has been abolished. New methods have come in which demand a lot of granularity, which takes care of certain adverse scenarios known as tail risks. And the approval for the new internal method under market risk is stringent. So initially, market banks or financial institutions should adopt the standardized new standardized approach under the market risk, which will definitely be quoting RW values higher compared to the old method, which is VAR. So CVA, so it will be more risk sensitive and lesser netting benefits. So definitely it's expected increase. CVA will roll up under is actually a component of credit risk. So that is also expected to increase. And output floor, so that will increase mainly because the IRB output now will be at least 50% increase. So that will definitely mean you need to set your RW estimates will be 50% higher even if you are to use IRB. So would be the amount of capital set aside. So overall, netting across or cutting across all these categories, large banks may see a 15 to 25% RW inflation related to Basel III. So over the next 5 years, are they slowly adopted and implemented? This can be seen in the balance sheets or the disclosures of major banks or the GSIBs. Okay, strategic implications for bank. This is more of a governance perspective. You need to design how your products are offered to clients, because now even if those products are under the IRB treatment, they will be still under the output floor, meaning the RW estimates will be higher. That means you need to go to the drawing board, redefine or replan how you offer those products. Data and systems, massive upgrades for market risk requirements, FRTP, operational risk requirements, and CVA requirements. Business strategy. So now low risk mortgages will attract lower RW, meaning you need to set aside, you can set aside lower capital for them, so that benefit can be passed on to the customer. And lower CR exposures also will attract lower RWA, meaning you can pass those benefits. At the same time, when they're high risk, you need to set aside more capital, you need to charge more. So the pricing needs to be decided accordingly, or probably based on the risk profile of that lending. It cannot be uniform pricing going forward. So model governance has got very stringent. The parameters have got increased. The floors have got increased. Historical data requirements have got increased. So earlier, banks used to spend a lot of money on model development and reap the benefits by quoting lower RWAs for years to come. That will cease now, and now even if you have to develop a model, that will be impacted due to the higher floors output, then the restricted or constricted output under the output floor. So even if you have to develop a model and invest a lot of time and money, it will not be rewarding in the future. And like I said, from a regulatory lens, for the same set of customers and the same set of banks of equivalent size, the RWA need to be more or less uniform. And if there were to be variances along those lines, that needs to be explained or probably will be investigated by the regulators. Okay, takeaways. Basel 4 is Basel 3 plus revised standardized method for credit, market, and op risk, restricted IRB, new SMA risk for op risk, revised CVA, output floor of 72.5% is the game changer, and enhanced leverage ratio for GSIPs plus Pillar 3 disclosures. This is the takeaway of Basel 4, or like we saw in the beginning, the 7 points where Basel 4 has really made a lot of difference or made a complete overall or a killing from a regulatory lens. Okay, that's a sneak peek about me. So I hope you like this video. I shall attach a copy of the slides. For more such videos, like, share, subscribe. Good luck.